All right, everyone. We're going to do Handout 5, and Handout 5 is taking a company's books from cash basis and converting them to accrual basis. So the information that we're given is the December 31st accrual basis balance sheet, which if it's December 31st, 2019, then that means it's going to be our beginning balance for 2020. So we're given all this information. And then we're also given the information that happened during 2020. So this is all of the stuff that happened during 2020. And so what we need to do is take our books from the beginning of the year and kind of add in everything that happened during the year, even though this is all kind of on a cash basis, and make sure it's on an accrual basis. So the first thing I like to do is to go through each number and kind of categorize them so we can kind of make the income statement a bit easier. So first thing is we have our cash receipts from customers, and so that has to do with our sales. Then we have cash payments that happen during the year. So cash payments to vendors for inventory has to do with our inventory. Cash payments to employees has to do with our salaries expense. Cash payments for prepaid supplies has to do with our supplies expense. For other operating expenses, that just goes into other operating expenses. Cash payments to stockholders has to do with our dividends. And then cash payments for the 2019 income tax liability that was paid on March 15th, 2020, it has to do with our income tax expense. Then we have this other information. So what we owed, or what customers owed to Mega, that has to do with our accounts receivable. What Mega owed to vendors for inventory has to do with our accounts payable. What Mega owed to employees has to do with our salaries payable. Physical count of inventory has to do with our inventory. Physical count of supplies has to do with our supplies. And then they give us our income tax rate for 2020. Some other information, they say that Mega depreciates its equipment using the straight line method over 10 years with no salvage value. We can also assume that the balance given for other operating expenses is the same for cash to accrual. So they're saying here that other operating expenses, that this number right here is going to be the same on cash and accrual basis. So there's no adjustment needed. So the first thing we want to do, so they're asking us to prepare an income statement and a balance sheet. And we're going to prepare our income statement first because with our income statement, we do need our net income for our balance sheet. So we're going to do the income statement and then we're going to do the balance sheet. So here's our income statement. I'll kind of go through the whole line and then we'll go through each number. So we have our sales minus our cogs. And within our cogs, we have our beginning inventory plus our purchases equals our cost of goods available for sale minus our ending inventory equals our cogs. So our sales minus our cogs is going to be our gross profit. And here's a little formula right here. After we find our gross profit, we're going to subtract all of our operating expenses. And those are our salaries expense, supplies expense, depreciation expense, and our other operating expenses. So once we find our total operating expenses, we're going to subtract that from our COGS, and we're going to get our income before income taxes. Then we are going to subtract our income tax expense from our EBIT, and we're going to get our net income. And that's our income statement. So let's see how we are going to calculate each number. So I have these formulas up here, but we will use them as we go down the income statement. So for sales, we do have a formula for sales. So our sales on an accrual basis are going to be our cash receipts. And that's just this number, this cash receipts is what we would be reporting on a cash basis, but we're doing accrual basis. So there's a few things that we need to add in, a few things that the company is going to report on an accrual basis that they wouldn't normally report on a cash basis. So we have our cash receipts plus our ending accounts receivable minus our beginning accounts receivable. So if our beginning accounts receivable is one number and our ending accounts receivable is a higher number, that means our AR increased during the year, which means we had credit sales. They haven't paid us yet, but we did report sales. And on an accrual basis, that is reported. On a cash basis, it's not. So we have to add that in. And then we also have add in our beginning unearned revenue minus our unearned revenue. So that means that we have our one number of beginning unearned revenue and we have our ending unearned revenue. And if the beginning unearned revenue number is higher than the unearned revenue, which means it decreased during the year, when unearned revenue decreases, when we debit unearned revenue, that means our revenue has now been recognized. It went from unearned revenue to earned revenue. So that would also be added into our sales. So let's see how we get these numbers. So cash receipts. We have our cash receipts from customers, 67,300. So that's going to be that first number. Now we have our ending AR and our beginning AR. So our beginning AR comes from our beginning balances, which is going to be 4,200. And our ending AR, which we labeled here, is what customers owe to Mega, which is 5,900. So ending AR minus our beginning AR, our 5,900 minus our 4,200 is 1,700, which we're going to add to our cash receipts. So our sales for the year on an accrual basis is going to be 69,000. All right, moving on to our COGS formula. Our beginning inventory is given to us, which we get from our beginning balances. So beginning inventory, 5,600, which we're going to put in. Now our purchases, we do have a formula for. So in addition to the cash that we paid to vendors, we also have to take into account our accounts payable. So if our ending accounts payable is one amount and our beginning is another amount, if our AP has increased during the year, then that means we've bought stuff, but we haven't actually paid cash for it. So on a cash basis, we're only going to report what we paid actually with cash, but on an accrual basis, we also have to take into account how much our AP has increased during the year. So first number, we have our payments to vendors, which we're going to find our cash payments to vendors for inventory, which is going to be 30,600. We put that right there. And then we're going to find our ending accounts payable and our beginning accounts payable. So our beginning accounts payable comes from our beginning balances, accounts payable for inventory, 6,100. And our ending accounts payable, which we labeled here, Mega owed to vendors for inventory, 7,000. And that's our ending inventory. So our ending is 7 and our beginning is 6,100. So we're going to add in an additional 900 to that cash payment to vendors, and we're going to get a total purchases of 31,500. So we have our beginning inventory and we have our purchases, which gives us our cost of goods available for sale. This number plus this number equals this. Now our ending inventory is given to us, which we have right here, a physical count of inventory, 6,300. So we're going to put 6,300 in, and our cost of goods available for sale minus our ending inventory is going to give us our COGS. So now that we have our COGS, we can take our sales minus our COGS, and they give us our gross profit. All right, moving on to our operating expenses. So for salaries, let's start with salaries. So on a cash basis, we're only going to report what we paid cash to our employees. But on an accrual basis, we also have to take into account how much our salaries payable has increased during the year. So that's going to be our ending salaries payable minus our beginning salaries payable. And here there's a formula for it right here. Payments to employees plus our ending minus our beginning salaries payable. So first, let's find the cash paid to employees, which they give us in our information. So cash payments to employees, $15,500. And that's going to go right here. Then our ending and our beginning salaries payable, let's find. So our beginning salaries payable, they give us that information, our beginning balances. Nope, that was the wrong number. Salaries payable, 500. And then our ending salaries payable is what we owed to employees at the end of the year, which is 900. So we're going to do our ending minus our beginning, and we'll get an additional 400 that we need to add to this amount. So our total salaries expense on an accrual basis is 15,900. All right, so supplies expense. We also have a formula for supplies. So in addition to the cash payment for supplies, we need to see how much beginning supplies has, or how much supplies has decreased during the year. If we buy supplies, we are going to debit supplies and either credit cash or accounts payable, right? But once we use those supplies, we debit supplies expense and we credit supplies. And so we need to see how much supplies has decreased during the year to see how much our supplies expense has increased. So first, let's find the cash that we paid for supplies. We have right here for prepaid supplies, 2,500. So we're going to put that number right here. And then we need to find our beginning supplies and our ending supplies. So our beginning supplies is given to us right here. And our ending supplies is going to be our physical count of supplies at the end of the year, which is $1,000. So our formula is going to be our cash for supplies, 2,500 plus our beginning minus our ending. Our beginning was 2,100 and our ending was 1,000, which means it decreased. Our supplies account decreased by 1,100, which means our supplies expense account has increased by that amount. So our total supplies expense on an accrual basis is going to be 3,600. So now we have our depreciation expense. So we first need to find our equipment, and then they gave us some information about depreciation. So our equipment is worth $12,000. And they tell us here that they depreciate their equipment using a straight line method over 10 years with no salvage value. So what we can do is we can take the value of that equipment, the 12,000, divided by 10 years, and we know that our depreciation expense is going to be $1,200 for the year. Now, other operating expenses, they also gave us some information that it was the same for both cash and accrual. So we can take that number, other operating expenses, and just plug it in, the 5,500. So that goes right there. So now we have our 4 operating expenses, and we get the total amount of operating expenses. And we're going to take our gross profit minus our total operating expenses, and we're going to get our income before income taxes. Now we need to calculate what our income taxes are. They tell us here that our income tax rate for 2020 is 25%. So here, how we're going to find our expense, we're going to take this 12,000, we're going to multiply it by 25%, and we know that our income tax expense is going to be $3,000. And once you subtract that from this amount, then you get your net income of 9,000. And that's how you create the income statement from cash to accrual using all of that information. So these formulas are really helpful, and you can see where we got all the numbers. So now let's make the balance sheet. All right, so our balance sheet, there's 2 formulas that we'll need for this, but other than that, we basically have all the information. So the one formula we do need is basically going to be the first thing that we do. So we have our assets, our liabilities, and our stockholders' equity. And our balance sheet, we know our assets have to equal our liabilities and equity. So first, let's start with our assets. So first asset that usually goes on your balance sheet is going to be cash. And so here we have a cash formula. So what it's going to be is going to be our cash receipts from customers, all the cash that we got during the year, plus our beginning cash, minus all the cash that we paid out. So we had this beginning cash amount. We're going to add in everything that we got in cash, and then we're going to subtract everything that we paid out in cash. So let's find those numbers. So cash receipts, they give us that number. Cash receipts from customers, 67,300. So that's going to be our first number right here. Beginning cash, we can pull that from our beginning balance information. Beginning cash, 2,700. So we'll add that in. And then we have our total cash payment, all of the things that we paid cash for. And there's a few of those. So let's see where we're getting these numbers. Cash payments, right? It's going to be all of these numbers combined, and we're going to subtract. So we have 1, 2, 3, 4, 5, 6 numbers. So we're going to add those 6 numbers here, and we're going to total that, and that's what we're going to subtract to get our ending cash balance. So we have our cash receipts plus our beginning cash minus our cash payments, and our ending cash is going to be 7,900. Our ending AR, they tell us, is what customers owe to Mega at the end of the year, 5,900. Our ending supplies, they tell us, is our physical count of supplies at the end of the year, $1,000. Our ending inventory, they tell us, physical count of inventory at the end of the year, 6,300. And our equipment. Our equipment value stays the same. It's always going to be 12,000, but now our accumulated depreciation is going to go up because we had another depreciation expense during the year, that 1,200 that we calculated. So our beginning balance for accumulated depreciation was 4,800. And during the year, we had a depreciation expense of 1,200. So 4,800 plus 1,200, we're going to have an ending accumulated depreciation amount of 6,000. So we add all these numbers up, less our accumulated depreciation. Our total assets is going to be 27,100. Now let's move on to our liabilities. So our ending accounts payable, they tell us is what Mega owed to vendors, $7,000. We plug that in, $7,000. Our ending salaries payable, they tell us, which is what Mega owed to employees, 900. 900. Now our income tax payable, we calculated our income tax, the 3,000, but it's not due until the following year. Just like how the 2019 income tax liability was paid in 2020, our income tax liability for 2020 won't be due until 2021. So our income tax expense is going to equal our income tax liability, $3,000. Now we have our total liabilities of 10,900. Now we move on to our stockholders' equity. Common stock, nothing happened during the year for common stock. Nothing happened here. So we're going to pull the common stock from our beginning balance, the $7,000. And we're just going to plug that in. Now our ending retained earnings, we have a formula for. It's going to be our beginning retained earnings plus our net income minus our dividends. So This is why we needed to do our income statement before our balance sheet. So beginning retained earnings is going to be 6,200. Our net income, we're going to grab from our income statement, 9,000. And then our dividends, they tell us what they paid to the stockholders during the year. To stockholders, 6,000. So we do our beginning retained earnings plus our net income minus our dividends, and we get an ending retained earnings of 9,200. So our total equity is going to be 16,200. Now our total liabilities plus our equity is 27,100. And it matches our assets. So we balanced our balance sheet. And that is how you take all that information and convert it from cash to accrual.